So, how do banks make money? Obviously, we know they write loans, they charge people interest, but how do they really make the huge amounts of money that they actually make year after year? We're going to dive into that. We're going to talk about these big banks in today's training. Hey everyone, it's Mike Adams, and on this channel, we empower individuals to achieve freedom through improved financial literacy, business ownership, and real estate investing. If it's your first time here, make sure to click subscribe, click the bell, so that way you get notified whenever we release future content. So in today's video, I really just wanted to pull back the curtain and talk a little bit about how the banks make money and make sure that everyone on this channel knows how it actually works, how this banking system actually works. And obviously, when it comes to how banks make money, there's the ability to take a real deep dive here. And my goal here, and really with everything we put out on this channel, is to simplify things as much as possible. Maybe that's the Army veteran in me wanting to make things simple. They always told us, keep it simple, stupid. So that is what we want to do here as we walk through this illustration. And the bottom line, guys, is this. How banks make money, obviously they write loans, right? They loan people money, and then they charge people interest, okay? And that's how banks make money. And the bottom line is this, though: the banks are able to do something really special, and it's something that everyday consumers are not able to do. And it's what's called fractional reserve banking. And so how it works is banks, and I want to give you a straight line example here. Let's say, and let's jump online for this, just to make this really simple. I want to walk you guys through some numbers here. And so when it comes to fractional reserve banking, here's how this works. Okay, and I jumped online and I wanted to take a look. And let's say you had $10,000, right? And you want to go ahead and you want to deposit that at the bank. And so let's say you wanted to go ahead and put that into a bank CD. And so I wanted to look it up and look at these juicy rates here on these bank CDs. And it looks like, we're pretty close, to 3%. I mean, I'm seeing 2.75, 2.85% on a CD, right? And so let's say we did that. We took our 10 grand, we put it into a CD. So that means we cannot touch that money for 12 months. Okay, and rounding it up to 3% on 10 grand, at the end of the 12 months, they're gonna give you back your 10 grand plus 3%, okay, which would be $300 on 10,000, okay? So sure, you're able to earn that interest. That's fantastic. But how much are the banks making? And so when it comes to fractional reserve banking, okay, so you hand over $10,000 to the bank. And again, there's a whole daisy chain to this. But to make it very, very simple, when the bank has your $10,000, they're like, fantastic. What they do is they turn around and they look at the Federal Reserve. And what they can do is they can take that 10,000, okay, and request a loan for 10 times the amount from the Federal Reserve, okay? So your 10,000 becomes 100,000, okay? From there, they must keep 10% of that amount on their ledger. So your original 10 grand, they have to go ahead and hold on to that on their books. But now, out of thin air, they've created an additional $90,000. So your original deposit times 9, okay, that's the amount that they actually have available to them to lend out. So your 10 grand, okay, that they're going to turn around and give you 3% on, creates $90,000 that the bank gets to go out and lend because of this fractional reserve banking. And so when you put that in, let's put that into a new loan. So now they have this new 90 grand that they're going to turn around and lend out to Joe to put on his new mortgage. Okay, so let's go ahead and grab a loan calculator here. Okay, loan calculator, pick the top one here, bank rate, and it brings us here. And let's pop in this 90,000 bucks. So it's 90,000, and let's call this a mortgage. So put a 30-year mortgage on it. And let's just go with an easy 5%, okay, just to make it easy, and so that way you guys can follow along with the numbers. But even at 5%, and again, many loans are either, some might be below this, but many might be above this. Maybe this money, maybe the bank is lending this out as a personal line or a personal loan, or in a different way where they're able to charge quite a bit more interest. But either way, let's just call it 5% and calculate this. Okay, so we see this, and let's click where it says show amortization schedule, because we want to talk about this first year. And so let's scroll down here, and here's what we see. Okay, on this new mortgage that the bank was able to create off of your 10 grand, they were able to create a new mortgage of 90,000 bucks. Okay, look at all this interest that they're able to charge every single month as Joe makes the new payments on his mortgage. And going from March to March or April to April, okay, we're looking at 12 months times about 370. So let's just bring this up and go let's just call it 370 times 12, okay? So in the first year of that mortgage, the bank is generating almost $4,400 worth of interest, okay? So on the CD, they turn around and they hand you $300 in interest after the 12 months, but they were able to make $4,400 worth of interest on money that was created out of thin air. So this $4,400, again, bear in mind, that's just in the first year, right? Imagine if you were, obviously very excited about our CD, we're getting our 3%. And again, I'm shooting that a little high here, but, let's say you're getting that 3% and you wanted to roll it again. Give me another 3%, hold it for another year. Well, look, they get to charge another, big old chunk, all the way down to here. That's another $4,400. All right, so every year they turn around and giving you $300, they're able to use that same money. Okay, again, it's been leveraged out, it's been turned multiple times, but lent out again, simply because of your initial $10,000 deposit, this 90 grand that they created out of thin air. They're able to take that imaginary money and lend it out, okay, and earn huge amounts of interest in comparison to what they turn around and give you as a rate of return. That's how banks really, really make their money, is on that spread. And again, when it comes to fractional reserve banking, there is, again, a whole daisy chain as to how it works. But when you actually work out the numbers on the whole daisy chain, you're able to take that original deposit, it gets turned by 10, and then 10% of it is held, because again, most banks that do fractional reserve banking have what's called a 10% reserve requirement. So again, if they go to the Fed with your 10 grand, say, look, we got 10 grand, and the Fed says, okay, we can give you 100, they still have to hold that original 10 grand there because they have to have a 10% reserve on anything that they're lending out, okay? So again, they take your original amount of 10,000 and they're able to take that number times 9 and go ahead and lend that money out to someone else at a much higher rate of interest. So this is truly how the banks make a lot of money, and they're making money charging us interest, right? They're charging Joe interest on money that truly didn't even exist. It was only created because of fractional reserve lending in that banking system. So hopefully you guys found value in this training. If you have additional questions about fractional reserve banking, go ahead and put those in the comments. Make sure to give this video a like, and I will see you guys in the next training.